Good morning, Leanne. Good morning to everybody, and good morning to our esteemed clients. Thank you very much for joining this session. This year's budget seems to kind of had a more of a stable budget as opposed to what we've had last year. And we look forward to sharing some of the insights with you and what you could expect going forward into 2026-27. All right, so the first thing we have a look at is what's taken place with regards to the rand between 2025, 2026, being March 2025 to February 2026. We see all the macroeconomic indicators showing us that an average rate to the dollar was around the 17 mark for the year. As you are aware that last year there's been, or in the previous financial year, there were some variables that did play a role. The rand was doing an up and down scenario. Then it kind of stabilized between May and November period, and then there was a bit of an increase. So based on what we've seen, it was averaging around the 17 mark. The minister is projecting for 2026 global growth projections around 3.3%, and that 3.3% is coming out of key emerging markets and not from mature markets. So it's something to look at what's happening in the emerging markets across the globe. Domestically, South Africa is expecting growth projections of 1.6, a bit bold if you ask me. But if there is stability and there are key government infrastructure and other developmental needs that do occur, it could be possibly achieved sometime in Q3, Q4 of 2026, 2027. Again, these factors domestically will depend largely on what's taking place globally. So yeah, let's see. In terms of the 2026-2027 budget, if you have a look there, government's obviously projecting a revenue target of almost 2.6 trillion, with government expenditure being at around 2.8 trillion, giving us a deficit of almost 280 billion rand. Again, with that projected mindset of a 1.6% growth. In terms of the government expenditure, it seems coming off the President's State of the Nation address, the minister has prioritized those specific initiatives into basic education, health, social development, community development, economic development, which would include the economic initiatives and public infrastructure, safety and security being a big one, given the recent happenings of the Matlanda Commission as well as the Parliament Ad Hoc Committee on the SEPS inquiry. There seems to be a big emphasis to throw extra money into safety and security to get the safety and security portfolio kind of adjusting and working according to what they think it should be doing into 2026, 2027. So a lot of money has been thrown into that. And then, obviously you have post-schooling education and training. And then the big elephant in the room is government's debt servicing costs. So currently in February 2026, we're sitting with a national debt of almost 4.3 trillion rand. And the interest burden on this particular cost is just astronomical, almost in the region of 192 billion rand that's occurring in interest costs alone. So I think there's a key priority to stabilize and reduce debt cost, which then speaks to what has occurred in this year's budget being a more stabilized budget as opposed to aggressive tax increases, reducing other parts of expenditure, etc., etc. It's more stabilizing, more prioritizing, and more emphasis on reducing the national debt. So let's get into the tax proposal side. If we have a look at the tax proposal side, the first part that's relevant to all of our pockets on a monthly basis, personal income tax. We see a kind shift from last year to this year. The lowest income category of 1 rand to 245,100 rand at 18%. And somebody who's earning kind of the mid-income category of 530,000 to almost 695, 700,000, you're looking at 35%. And our executives that are earning beyond the 1.8 million, those are hitting at around 45%. The big tax break for personal income tax payers is in that 1 rand to 245,000 category. The general rebates below 65, 17,820, above 65 and 75, the 9,765 and above 75 for our senior citizens, the 3,249. The interest exemption below 65 taxpayers, individual taxpayers, stays at 23,800 and above 65 at 34,500. The tax changes and policy announcements in terms of the broad spectrum of taxes administered, legislated by National Treasury and administered by SARS. We'll run through this by category, and we'll start off with corporate income tax. There's been no change to the corporate income tax. It stays at 27%. Trust stays at 45%. The dividends tax stays at 20%. The transfer duty, acquisition of property, anything from 1 rand to 1.2 million or 1,210,000 stays at 0%. So effectively, if you're buying a property, anything in that class or value range stays at 0%. The estate duty tax between 1 rand and 30 million stays at 20%. Anything above 30 million stays at 25%. When we go to capital gains tax, a key driver for SARS in terms of revenue collection, we've seen over the years since the introduction of capital gains tax some time back, and we've seen some movement in the rate changes in the last 2 to 3 years. But this year, again, as I said earlier on, stability, and I think stability has been maintained in this particular space. So for individuals in special trusts, 18% net effective CGT rate, for businesses 21.6%, and for trusts at 36%. The big issue and controversy around last year's budget 1.0 going up to 3.0 around the VAT, and eventually, last year with the Government of National Unity agreements and disagreements, eventually, there was the whole saga around the VAT. This year, we see the VAT still staying at 15%. Annual contributions to tax-free investments, whilst also trying to be, able to, or whilst also trying to stabilize the budget, there seems to be some form of small incentive to encourage South Africans to save more, because the general trend and the blueprint produced by National Treasury in previous years suggests that South Africans are amongst the worst savers in the world. So I think, when you look at this initiative, the annual contributions to tax-free investments has shifted to 46,000 Rand per annum. The annual deductions for contributions for retirement funds, again, this has gone up to 430,000 per annum. And both these adjustments speak to the fact that you have government encouraging us to save more in the short term and save more in the long term, because the numbers clearly show that over the period of time, government will not able to afford the already huge bill that it has on social grants. So, encouragement to look after your own retirement when you reach retirement age, seems to be another driving factor as to why this has increased. A key deliverable or a key change, as you're also aware, that the VAT threshold has been at the 1 million mark for a very long period of time and has not really been looked into. And the administrative burden faced with small business enterprises, small, yeah, you could categorize them as small. There was a huge burden there with regards to the 1 million per annum threshold on VAT. This year, they had a look at this very detailed and decided, well, let's take away that small business liability or onus in terms of VAT from that particular sector and increase it to 2.3 million. So this effectively means that going forward into 2026, the VAT threshold now will be 2.3 million for a 12-month period. So, if your business is obviously occurring turnover of 2.3 million in a 12-month period, then, you will have to have a look at the VAT liability and compliance measures around that. Currently, anybody below 2.3 million, what would naturally happen as March and April months unfold, SARS would potentially issue a letter to those particular VAT vendors and inform them that based on their previous years or their last years of declarations made to SARS, they either see that your turnover is now dropped or your turnover is below this particular threshold, and you may have an election to then voluntarily deregister, or you may then keep on your registration if you so wish to. But I would think they would clear out a lot of small businesses that are affected by this who intend to deregister. On the social grants front, like I said on the earlier slide, you see the bill is almost reaching 292.8 billion rand. It's a huge number. And I think this number is just going to get worse in the next year. And hence, government is encouraging even more to say, we don't have money in time to look after your retirement. Please do something to look after your retirement yourself, or else you'll just sit with the state or pension grant. So yeah, it's a bit of a challenge. It is a huge challenge, and it is what it is. It's a huge number. The child support grant has also gone to 80 rand, the foster grant to 20 rand, and then the additional grant of the 45 rand. All right, if we have a look at here, provision for free basic services as identified in our very unique constitution that we have. I think the key crises that are taking place nationally being water, sanitation, and other basic services. The minister has thrown in 86 billion rand into that pot. Where this 86 billion rand will go to, I would think immediately what comes to mind is the city of Joburg, Ekurhuleni, Nelson Mandela Bay. Those are, the ones that initially just ring a bell of where, the key basic services and infrastructure development is required. So, nationally, the minister has obviously come in and seen the crisis, and they, funding this money to then obviously deal with that crisis. How quickly this will happen and how effectively this will happen is yet to be seen in the coming months. Withholding taxes on royalties, interest, foreign entertainers, and sports persons, this has gone to 15%. So this is generally for, a withholding tax on any of these type of individuals that come into South Africa to perform certain services, be it, entertainers, sports people, etc. Again, we did speak about the 2.3 million VAT threshold. On the capital gains tax, if we have a look at there's these exemptions that apply on the disposal of primary residence for a special trust. There's a 50,000 Rand exemption. Then a big one that has moved from last year to this year is the disposal of primary residence. So on your primary residence, there's an exemption of 3 million Rand. And then there's an exemption of 440,000 on your, or shall I just rephrase, in the year that you die. So in the year that you die, if there's any capital gains tax to be accrued for in terms of your estate, there's an exemption there of 440,000. The National Student Fund Aid Services, generally referred to as NSFAS, for all students applying, excuse me, for all students applying for bursaries throughout the universities in South Africa. That funding is now sitting at 54.3 billion nationally. Donations tax exemption. Donations tax, there was an exemption of 100,000 between spouses. It's now moved to 150,000 into the 2026-27 financial year. Cross-border credit and debit payments per transaction limit is 100,000 limit there. National Treasury, together with SARB, the South African Reserve Bank, have obviously monitored the flow of cross-border transactions via debit card payments, and they found that Reserve Bank was comfortable enough to find that they're comfortable to move that figure to 100,000 per transaction limit. So that's also a kind of a good announcement in terms of a lot of payments going from small business or individuals or other, where there's been constant delays or blockages from the Reserve Bank. And I think in order to enhance that process, they have increased this limit. The single discretionary allowance per South African citizen in your individual capacity has moved to 2 million Rand per annum. So each individual is allowed to now have, to move 2 million Rand across as a single discretionary allowance. Yeah, they call it sin tax, not for nothing, eh? It's a general trend that happens every year without doubt in the budget. The alcohol, beverages, cigars and pipes and tobacco and cigarettes and other related tobacco products. What I've noticed this year is there's no variance in the percentages. They've kept it at 3.4% across all type of products in this particular category. Let's have a look at some other important information to take note of for businesses in terms of the South African Reserve Bank. There's been two circulars issued, Circular 15 and Circular 14. These circulars talk about, the necessary exchange control mechanisms in line with tax compliance obligations that SARB would implement when, foreign tax or foreign transactions are done with respect of movement of monies offshore or, investments offshore or obtaining, necessary compliance with regards to a certain transaction. This is targeted mainly at outflows going out of South Africa into other jurisdictions. So these circulars, they generally get updated at budget day. And, if anything like really pops out, we have a look to see what are those fundamental changes that affects you on a daily basis in terms of the business environment. But in terms of Circular 15 and Circular 14, as we see them, they generally deal with the same type of compliance measures that must be in place in terms of paperwork, nature of transactions, details of transactions, which jurisdiction is it going to, what's your tax compliance status in South Africa, etc., etc. So all those normal compliance measures are still in place. and they will execute them as accordingly to what has happened in the previous financial year. The planned introduction of digital invoicing for VAT. Yeah, this seems to be quite a big one. So the European Union currently across all EU countries have already moved, certain countries already moved to digital VAT invoicing. And SARS has obviously looked at this and seen what the impact would be from a South African perspective and how we fit into this global picture. With that said, SARS has already moved into this digital space, and I think a lot of development and technological advancement is taking place in the SARS background to also start implementing this VAT modernization program. What we may see into the current year is potential announcements coming out of SARS with regards to how SARS intends to implement the digital VAT invoice system, what that mechanism will look like, how will the compliance be monitored and measured, and how will VAT vendors need to adapt to this digital invoice system. Whether that will be implemented in the current year or into the next financial year is yet to be seen. But what we understand is that, they're moving quite fast on the space, given the level of VAT fraud that is continuously taking place. So they seem to see the results taking place in the EU member countries. They seem that those benefits may just also flow through in the South African context. So you may see a very rapid movement in the space, or you may see everything set up this year and potentially implemented in, maybe into 2027, 2028. The bottom line is digital invoicing for VAT is coming, and it will come. And, we will keep you abreast as to how this will work. We've had some insights as to what the framework and mechanism would be, but, we wait to see the end product to see exactly what the implementation steps are and how you would then digitally invoice. So we'll keep you abreast on this front. It's something to take note of. Crypto assets, a big talking point and a big money spinner for SARS. It's been identified that, a lot of taxpayers, almost 5.3 million taxpayers in South Africa, are playing in the space. And naturally, SARS sees that this is a big revenue spinner for them, given that, whether a taxpayer is declaring their crypto trading or not. And with that said, the minister has now announced draft regulations for cryptocurrencies to be introduced into the capital management framework. What this means is that they regularizing the crypto more into the formal system. As you also know that crypto, because it's globally, it's not regulated to the extent that some tax authorities want it to be regulated and the central banks. And South Africa has now moved into this position to put more regulation around this measure so that they can control exactly and have a more view of exactly what's happening in terms of the movement of these transactions from a SARS point of view, and then share that intelligence with SARS, and then SARS will naturally do their data mining on the background of those particular taxpayers and see to what level are you in compliance with your declarations on your physical tax return in respect of crypto trading if you are playing in this space. Interaction of controlled foreign companies. So, ladies and gentlemen, you would recall last year there was a massive court case that took place with regards to a taxpayer and SARS fighting around this particular CFC section of the Act. So the case is called Coronation versus the South African Revenue Services. It's been a huge case. It's been going on for some time. And the taxpayer naturally won that case in the Constitutional Court. So, it first went to the tax court, to the High Court, then to the SCA on appeal, and eventually it found itself at the Constitutional Court doors. The taxpayer eventually won this case. It's quite a significant case, as I've explained. And what has then happened is naturally, National Treasury looked into this particular matter, and they've obviously, seen where the loopholes needs to be closed or what needs to be amended in order to ensure that from a Treasury point of view, the Section 9D is, even more tight than what it was before. With that said, the two aspects that come into mind is obviously the high tax exemption. And then secondly, when CFCs are taking place, the second thing is that comes into play if taxpayers claim from a business perspective, I have an operation offshore and it's totally independent, it's in another jurisdiction, it has its own permanent establishment, it has its own management and control, it's not related in any way to South Africa, and all these technical arguments that come into play, then naturally SARS looks at Section 9H to see whether there's an exit tax charge that did occur at the time when you went offshore. So these two provisions that have come into their, shall I say, that have come into their domain very high given the court case. They will dig into the CFC rules quite a bit, and what we are expecting is more enforcement, audit, and investigations taking place around these going into 2026, 2027. Introduction of the global minimum tax charge. You will recall that the global minimum tax charge is applicable to global organizations that has a certain presence throughout different jurisdictions, and those were implemented from a South African point of view, already legislated and came into operation last year. So South Africa is already in this space. I'll just give you an example. It refers mainly to global organizations with a minimum turnover of 750 million euros and upwards, where you have this particular global minimum tax applicable. So just to give you an update as to what the global minimum tax regime is about. On the SARS legal and compliance items, in the last financial year, SARS has issued the following rulings interpretation notes, as it's referred to in the tax world. The first one is Section 10(1)(c). It's an income tax exemption with regards to registered political parties. This particular ruling has been issued by SARS with regards to political parties. There has been some issues in screaming in the economy around political parties receiving donations and the income that they received, etc., etc. So SARS has issued an interpretation note around this particular aspect, exempting them from that particular income. The second one issued interpretation note 142. This was issued on 12th December. Paragraph A of the definition of interest in Section 24J1, the meaning of similar finance charges. So naturally, ladies and gentlemen, you would appreciate that most of our operations would entail some form of finance arrangements, whether it's long or short-term loans that you secure or other types of debt funding. And naturally, one takes into account the aspect around the interest deductibility that you pay. The big issue around interest deductibility that comes to the fore is, have you then occurred this loan in the production of income test? That's been the primary focus of the production of income test in order to see whether, the interest is applicable or not. And there has been some abuse, there has been a lot of abuse, and there has been, to some extent, some aggressive abuse taking place around interest. And you will see that the Section 24 has changed and has evolved over a period of time. And this year is no different. The SARS has simply then just issued a new interpretation note around this particular aspect in terms of similar finance charges and the meaning of what similar finance charges is and whether that is interest or not. All right, so let's have a look at some court cases. The court cases that we found quite interesting into the last financial year was a Taxpayer Trust Commissioner for SARS. What happened in this case, SARS challenged the trust arrangement and assessed the taxpayer on the basis that the structure was not genuine. The dispute focused mainly on whether the trust actually operated as a real independent structure. So this particular case focused on the taxpayer, set up a trust and, tried to do some structuring around that. And SARS found this kind of contentious and felt, well, we need to attack this. The key points that came out of this particular case was the taxpayer had to prove that the trust is genuine. If SARS challenges it, SARS cannot simply allege a sham without proper grounds. Documentation and administration carry more weight than intentions, and properly run trusts are recognized by the courts. So a practical takeaway is a trust is defended through its administration and explanations. Annual resolutions, distribution records, and proper accounting determine whether the structure survives an audit. In summary, what we're saying is that if we're moving into structures where we form trusts, these trusts need, firstly, from a compliance perspective, to be in order. What must be in order? You need to have everything that gels, firstly, when you form the trust and the structure of the trust and the purpose of the trust, and everything that goes into the trust deed speaks to the execution, the governance, and other. With that said, when SARS comes and starts attacking the trust in whichever form or manner that you've structured, you have the first pot very well oiled and maintained. It makes it easier to then defend any aspects with regards to SARS attacking it from an audit or investigation point of view in terms of any aspects that they may target within the trust, be it an income aspect, be it a deduction aspect, be it a CGT event, or whatever else. So that's the key takeaway from what we see from this particular case. The next case, Flower versus Commissioner for SARS. SARS imposed understatement penalties after disagreeing with the taxpayer's tax treatment. The taxpayer argued the position was taken reasonably and based on advice. Now, ladies and gentlemen, as you are aware that the understatement penalties in the Tax Administration Act has been deliberately legislated in there when the Tax Administration Act was introduced. And the understatement penalties range from 1% up to 200%. And SARS applies this as a big cash cow. And it's made a lot of money out of understatement penalties in various forms or manner, i.e. non-submission of returns, i.e. overclaiming a deduction not allowed, i.e. Not declaring the full income. And there's many other factors that where SARS imposes understatement penalties. With that said, there's also been some cases that's come to the court besides the Flower case, where the taxpayers were found to be in the wrong, And in other matters, SARS was warned to not just haphazardly impose penalties without just cause, because SARS was getting away with the fact of just imposing penalties and imposing penalties, and then the taxpayer has been left with a process of objection or appeal to then obviously remove those penalties. So this particular case, the key you'll see from the outcome, the court held that a wrong tax position does not automatically justify penalties and evaluate the taxpayer's behavior rather than the tax result. A very important point to note there that even if the taxpayer took a wrong tax position, it does not naturally allow for SARS to impose penalties. But an important takeaway is to ensure that you get prudent tax advice, whether it's compliance, whether it's an advisory or other. It's to demonstrate that you've at least obtained some form of discipline in taking the position that you've taken in order to come to the outcome that you've come to, and you've applied that outcome. And I think, once you show that, and, if SARS disallows that and you go on objection and they disallow the objection and you go on appeal, and they disallow the appeal and you'll end up in court, you will comfortably able to show a competent court that you have taken reasonable steps to get to the position you've taken to. You haven't just willy-nilly or become a cowboy and applied what you did. And I think that is something that, one must consider to be on the safe side to come out of this penalty box. The Commissioner for SARS versus Woolworths. We all like the Woolworths brand and the Woolworths foods. The shops are quite attractive nowadays. Anything you want, you just find at Woolworths, eh? What happened in this particular case? SARS denied VAT deductions on costs incurred in raising capital for a corporate acquisition. So the VAT cost incurred by Woolworths with regards to some acquisition that they made, the court held that the transaction formed part of the company's enterprise and allowed the VAT deduction. This is not so much of a capital versus revenue nature for income tax purposes, but more focused on the VAT side when a business is doing a transaction, and in this transaction, you occur some costs related to the transaction. And naturally, those costs, whoever those costs come from, whichever service provider has given those services and occurred those costs, if that service provider is naturally registered for VAT, then you would be entitled to then claim the VAT for that. And that's what happened in this particular case with Woolworths. And obviously Woolworths then obviously fought this and went all the way and then found that the deduction is allowed. So on any key transactions where you're doing a major transaction and that transaction attracts VAT, the related cost, not the transaction cost itself, and those related costs relate or have some form of VAT in there, here's a confirmation that those costs can be claimed. Commissioner versus SARS and Africa Cash and Carry, Crown Mines, and other case related to this. What happened in this case? SARS alleged that the company transferred its business and assets to a related company to avoid paying large tax debts. To prove this, SARS relied on affidavits, court judgments, and correspondence from earlier legal proceedings involving the same parties. The taxpayer argued that this was hearsay evidence and should not be allowed. What did the court decide? The court allowed SARS to use this evidence. The court held that previous judgments are public records and admissible. Affidavits and correspondence may also be admitted where justice requires it to be. The evidence was necessary to understand the relationship between the companies and possible tax avoidance. The court therefore allowed SARS to rely on the full history of transactions to pursue the recovery of such debt. What is the fundamental aspect of this case? I'll put it for you in very practical terms. If you're busy with a case with SARS in a court of law on a specific matter, and you have other unrelated cases happening elsewhere, and those other unrelated cases have a link directly or indirectly to the matter that SARS has with you, what the court is saying is that SARS can go for those cases, see what's happening in those unrelated or related cases, and use that in their argument or defense in the case that they have against you. That's literally what's happened in this particular case, and that's what will happen going forward because they've now got this confirmation from the court that they can do this. So just be aware that when we enter into litigation, one needs to be, telling us the full story. I want to take this thing to court. SARS has disallowed a deduction. It's a big number for me in my business, and it's going to affect me big time. But at the same time, I'm also busy with another related or unrelated matter, and it's also before the courts. So one needs to be aware of all these things, and it's a strategic and tactical move that taxpayers needs to apply, so you don't get caught into this type of situation like this taxpayer has done. Just a continuation from this case, as I've summarized there, courts may admit hearsay evidence in tax recovery matters where fairness requires, and SARS can rely on earlier litigation involving the same parties on similar or unsimilar matters that they would like to use. SARS versus Roy Muleya. This particular case, we see what's happened here. SARS claimed that Mr. Muleya owed more than 188 million in income tax and customs duties. While he was disputing the assessments and appealing, SARS applied to sequestrate his estate and transferred property to a family trust. Mr. Muleya argued that SARS was bypassing the tax appeal process. The debt was disputed. The sequestration should wait until the case was finalized. How did the court look at this, and what did the court say? The court said it allowed SARS to proceed and granted provisional sequestration. The court held that the commissioner has legal standing to bring recovery proceedings on behalf of SARS. The tax dispute do not stop recovery, pay now, argue later rule. And the sequestration may proceed even if an appeal is pending with court leave if required. Transferring assets to a trust after the tax demand indicated insolvency conduct. So practically what this means also is that while you have these proceedings taking place in a disputed matter, if SARS for any reason suspect or believe that they see you starting to transfer assets or you intending to do other things that is going to be detrimental to them in the collection proceedings, should they win the dispute matter with you, then they in the interim can implement debt recovery steps. And those debt recovery steps include sequestration, debt recovery judgment orders, etc., etc. And they're relying still on the basis of the pay now, argue later rule, which has come out about almost 12, 13 years ago on the Matt Cash versus SARS matter. So just be aware of this as well. It's quite an important case. Ladies and gentlemen, we thank you once again. Have a lovely Friday afternoon. Be safe. Have a good weekend and look forward to interacting again. Thank you so much.